Nick, so good to see you. This message is for everyone. As the end of the year creeps up, do not let the IRS keep your money. It is time to start thinking about year-end tax moves. Most of the money moves that could save you money on your 2025 tax bill do need to happen before December 31st. So we do have a quick checklist for you. First on that list, make sure that you are maxing out your 401k. The 2025 limit is $23,500 if you're under 50, and you can up your paycheck contribution if you can, of course, and consider increasing your Roth contribution.
Absolutely. So you can make that 23.5 contribution under the age of 50. You can also make the additional contribution or the catch-up contribution to get your contribution all the way up to 31,000. And for this year, for high earners, this is the last year that you can make a contribution to pre-tax dollars on those catch-up dollars up to that 31,000. So it's almost that 2025 becomes even more important to make those catch-up contributions if you can and if you want to this year, especially if you're a high earner.
Right. All right. Next, if you have a high deductible health plan, make sure you are contributing to your health savings account. Nick, I know this is one of your favorites because it is uniquely triple tax advantaged.
Absolutely. I always say pay your fair share of taxes, but don't tip the IRS.
Right.
Find ways to keep money into your pocket. And HSAs is, I think, probably, if not the best way, one of the top 2 or 3 ways to be able to do that, because you can make that contribution and get a tax deduction for it. You can let it grow tax-free. And when you pull it out for medical expenses, it also comes out tax-free. And what's really neat about retirement planning with HSAs is the IRS has come out and said that you don't have to have that medical expense and the distribution happen in the same year. So you can allow those HSAs to continue to grow. You can invest them and let that compound growth happen, save those medical receipts, and then you can take out those distributions later on, which is a big, big benefit for a lot of people.
Especially in retirement with those healthcare expenses.
Yep.
And even though, of course, you do have until the tax filing deadline, this is your friendly reminder to max out your Roth IRA.
Yep. So this is not a December 31st limit or deadline that you have with the Roth contributions to this. But it is one of those things that we always recommend getting that money into an after-tax vehicle. Keep Uncle Sam out of your pocket as much as possible, and get that money over to the Roth IRA. The December 31st deadline with the Roth IRAs is for the conversion. So if you're looking to convert money from the IRA over to the Roth, that is a December 31st deadline that you do have to follow.
All right. And it's also a good time to consider selling your stock losers. This is known as tax loss harvesting.
Absolutely. So pulling that money out of those non-qualified, if we're holding on to an asset that is generating a loss, being able to use that on your taxes to take away some other taxable income is definitely a big benefit. So if you do have that non-qualified investment and it does have some of those stragglers in there that just don't seem to be keeping up or going the opposite direction and having that tax loss, it's definitely something to consider, going through that tax loss harvest.
And last, be tax smart and do good. Donate to charity. Even if you don't itemize, you can still deduct up to $2,000 if you're married.
Yeah, absolutely. So, giving that money to charity not only helps you on the tax side of it, but also helps the charity, in the long run as well. So donating to charity is definitely something that we encourage a lot of people to do. Like I said, not only helps you, but also, helps somebody else out along the way. And then also, using qualified charitable distribution. So those that are over the age of 70 and a half, definitely, taking the money from the IRA and giving it directly to the qualified charity, I should say. Some of us think our kids, could be that charity, but that's not the case. But make sure it's a qualified charity that you're giving to, but it could be something to where you're not seeing any taxable income from that charitable donation.
And then just a special reminder for all of our procrastinator friends out there, it's never too late to start thinking about 2026 too, right?
Absolutely. Yep. So definitely thinking about 2026. Can't do anything, prior to that. We can't take RMDs, this year and apply them to next year and so forth. But definitely getting a jump start on that planning is very important going into 2026.
Absolutely. All right. Well, Nick, if somebody would like your help with these year-end tax moves, or if they would like you to keep them accountable for next year, what's the best way to reach you?
Yeah, absolutely. Reach out to us online, ewgretire.com. You can schedule an appointment there or reach out to us. Otherwise, you can give us a call at 937-498-1128, and we can get you set up with an appointment. Come in and talk about these different tax planning
Great.
advice pieces. So
Wonderful. Nick, thank you.
thanks, Aaron.